So I want to go over one of their annuity products that I've used in the past, which is a great way. So the products I'm going to show you are products that if you have people who really didn't get behind in saving money for retirement and need a boost to their retirement, and the main focus is income, retirement income. Okay. And I tell people there's two choices out there. Okay. Well, not two choices, really one. Income's king, and I've said this a million times, cash flow. You can't, run a business without cash flow. You can't live in retirement without cash flow. You're going to need as much income or cash flow in retirement as you can get. I mean, if an individual can retire and replace 70% of the income that they were making before they retired after taxes and inflation, they'd be doing really, 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 really good. Okay. I've been doing this a long time. Like I said, I've worked with federal employees all across the country, some of the highest paid people. And when we look at them with their TSP plan, which is a 401k in retirement, only, well, when they retire, almost 87% of all those federal employees are going to have a gap or a reduction in income on day one retirement of anywhere from about 42% on up to about 64%. So that means most people are going to see a 50% reduction in income on day one. And the further they go out in retirement, that income gap can get bigger or the income could stop. Why? Taxes, inflation, market risk, longevity. All of those things can cause those income streams to reduce or those income streams to be cut off, okay, or stop, run out of money, okay? That's why we look at fixed index annuities. So if you have most people don't have enough money saved, okay? So that's why when we look at products like what I'm going to show you, these are income products. I tell people, now, if you want something that's going to straight out give you great accumulation, the highest ability to accumulate your money and all that with no market risk, the NAC Benefit Solution 10 with North American is not going to be the best fit. But if you want to give your money a little boost of like 20%, okay, the NAC Benefit Solution 10 would be a good place to look at. Now, the Solution 10 also comes in the 7 year, okay, and you have the 10 year. Okay. And I've sold this many a times. And in here in the benefit solution, uh, so, obviously we all know the benefits of a fixed index annuity, guaranteed income, that you can't outlive, a way to help with possible nursing home care or other expenses, and then also a death benefit protection to leave for a legacy for the beneficiaries. So, and we know death benefit, lifetime income, tax deferred growth, of course. Um, lifetime payments, enhanced payments for qualified care center. This one doesn't pay if you cannot perform two out of your six ADLs, but if you get admitted to a qualified nursing center, it's going to double that income for 5 years, like most of them. Now, they also have a rider for death benefit, and I'll show you where the value that the income value that's accumulating, okay, is going to also provide a death benefit where it's like in most fixed index annuities, your accumulation or your cash value, when the person passes away, that's what the beneficiary gets. Any balance left in the cash accumulation, that is what's paid out as the death benefits. Here, the amount paid out as a death benefit is going to come under that amount under the income value as it's growing before you start income. So lifetime permanent nursing home death benefit. So let me show you here. So they have a different, so in the first year, and they don't call it a bonus with North American. So whatever you put into the benefit solution, they're going to pay you 120%. Okay. So in day one, so the benefit grows to 120,000. And let's say nothing happens in the market, okay? On year 10, okay,
Six. It starts at
it
year 6.
Year six, excuse me, year six, not year 10. Year six, now they're going to add 150,000. So now we grow to 150,000. Okay, 150%. That's 150% of that amount you originally put in. Okay, of 100,000. So, and then starting year 10 or more, 180%. So they have different means, but most people, if we're going to use this for income, they're going to be within 1 to 5 years, maybe 6 to 10. So most people, they're going to get that. Basically, it's a 20% bonus on their money for income value. Okay. And people need to explain that. A lot of people don't explain that to clients, and the client looks at it, and I've seen agents say, "Hey, well, wow, look at that. Your account's growing by 20%, and you're getting a roll-up rate of 8%. Well, that's for income. That's not for the accumulation. And people need to discern there's two parts to a fixed index annuity that has an income rider. Nursing home multiplier, confined to a nursing home. Basically, they're going to double it for 5 years and so forth. So, you got a little more coverage there. The multiplier, of course, multiplies it for 5 years. So let me go
The death
to.
benefit was at the bottom there. That's really we wanted to focus on that today.
Yeah, yeah. Let me pull up an illustration here. Um, okay, I had it here. All right. Did that come on, Peter?
Yes.
All right. All right. So let me make it a little bigger. All right. So I'm having here value client $250,000, a guy 55 years old and with qualified money. Okay. So 55. He throws in 250,000. Of course, under the income benefit jumps up to 300,000. But that's also the death benefit over to the right here. Death benefit is 300,000, but that 300,000, you have to take that death benefit. They pay it to you over a 5-year period. Okay, so the beneficiary, in order to get the income value as the death benefit, the client has to accept to take the payment over a 5-year period. So they don't pay the 300,000 in one lump sum. Obviously, if we go to year 5, we see it jumps up to 375,000. Why? Because of that 150%. And then year 10, it jumps up to 450,000. This is the guaranteed page. Okay. So this is without any market index returns. So, if we look at, hey, who's going to give my client the best returns and so forth. So now, if my client turns on the income, say in year 4, okay, at age 59, um, he's going to be at $17,220, and he still has just a 300,000. Why? Because we don't have the index returns on this page. His multiplier would be 34,000. Again, the death benefit 300,000. Now let's just go further into the illustration with some index returns page. So this is with an effective rate of 5.14. Now we see the accumulation value, okay, uh, growing here. Now we see the death benefit under the accumulation value equals the same. Now, if the client wants the money in the lump sum for the death benefit, this is what they're going to get, okay, under the death benefit. Now, if we look over to the far right, okay, death benefit annual payment, 5 equal payments, okay? So if, let's say, my client doesn't turn on the income until year 10, the client would get $91,713 a year for 5 years. Okay. If they took out the money in a lump sum, they're just going to get 316,000. So you could see, if they took it out over 5 years, they're going to be close to $500,000 in cash versus the 316 as a lump sum. Everybody follow me on that? So death benefit on the NAC benefit solution, death benefit under the accumulation value pays out lump sum. If the client's willing to take it over a 5-year period, then it's going to receive the bonuses. Okay. which is really powerful. Okay. So, so if the client again turned on, let's say turn on the income in 5 years, the accumulation value is at 281,669. The income benefit has rose to 375,000. Their income's $22,838 a year. Put in a nursing home, 45,675. If they pass away, five equal payments of 75,000. And they only put $250,000 in to begin with. So
Can I interject here?
yeah, go ahead.
So, everybody on here, why is the five payments important? Does anybody know?
Um, for this one, would it be in regards to like being able to make more money over time? Because 300,000 to get over five, you're looking at almost $500,000.
So, if this was qualified funds and this is being passed to the kids as a
Taxes on it.
non-spousal IRA, they have 10 years or less that they have to spend down that money anyways, correct?
Mm-hmm. Mm-hmm.
So this way they could still get the benefit base even though they were going to receive this as a non-spousal benefit, right? Because otherwise they would have to take whatever the total death benefit is on the accumulation value and then convert that into another product to either accumulate it in. Well, they can't. They're going to have to make those installments because IRS wants their taxes on it. So it really is beneficial to have the death benefit paid out through the equal payments of five payments in the situation where you have a non-spousal continuation. Obviously, if it was spousal, they could just activate a continued spousal continuation of contract,
Peter,
adjusted to their age.
also taking it over the five payments with the boost up amount is going to basically help reduce their taxation because now
Correct.
they're receiving more money. It's like because you're receiving the bonus money. So now this gives the client's beneficiary the ability to receive that bonus money as a death benefit, which most fixed index annuities don't do that. Okay. Now they receive it as a death benefit, and that additional money is now helping reduce the taxes that individual the beneficiary will be receiving. So it's a win-win if people understand it, which most people do, hopefully. It's a great plan. It's got decent index growth in it. Okay. It's got, some sound indexes in it. Um, Performs well. I've written it, many times. You could turn on the income immediately. You don't have to wait 1 year, so you could turn on income immediately. And again, you're getting a sound, strong company in North American. So any other questions on that? Because I'll show you another one that gives you a additional death benefit.
I just want to state one more thing on that. So once
Sure.
again, if you have a client you're talking to, and this has actually happened to us, we went to this gentleman's house. He was not insurable because of multiple health issues. He wanted to make sure his house that was waterfront property was protected. We asked, well, you're not going to qualify, you're uninsurable, but do you have any qualified accounts? Because we have some death benefits on some of these other accounts that would pay out. And he's like, actually, I do. When we showed him the value and what it would pay out, he's like, that makes sense. And we went back and forth with this gentleman for like 2 or 3 weeks, but he wound up working with us and he wound up passing away 4 years after he took out the contract. And the money, there was an additional $120,000 of benefit to his wife, money that basically helped cover a lot of the taxes and stuff that he was worried about. Out of this particular contract here with the benefit solution. So we've actually, we've used this specifically for the death benefit in trying to help somebody that won't qualify because just medically you can't underwrite them, in excess of $50,000 of death benefit.
Yep, exactly. Also, uh, on here where you see the benefit base, so the five payments over here, 91,713 equals 480, 458. So in year one, if that client died, they put $250,000 into the benefit solution. And if they die, their beneficiary is going to receive $300,849. Not a bad gig, making, over $50,000 on your money, day one, right? If they pass away. Yeah, they have to take it over 5 years, right? So, and in 5 years they pass away, that beneficiary is now going to receive 375,000. So a big way where if they would have left that money in some other place in the market, maybe it grew, well, let's look at the accumulation value. In 5 years, at a little over 5%, grows to 281,000. Now we have the rider fee in here too, but still, 281,000 versus 375,000, that's a big deal. And also, you'd have market risk. So what would the actual accumulation of those funds be? I don't know, okay, because you have risk involved. And when we're talking about retirement money and guarantees and leaving money for your family, do you want that uncertainty of market risk and all those other things involved there? So, so that is one way to boost up that income. Now I'm going to show you another plan. Now, the other plan, next plan I'm going to show you is with Nassau Life. Now, Nassau Life is not, somebody like North American, okay? But with Nassau Life, using the protection income, personal income choice, protection, excuse me, personal protection choice, it does give you a benefit of a higher death benefit. But also Nassau is a company, again, I use like if I have somebody I think I'm gonna have problems with suitability, Nassau, when you actually are filling out the application, when you go through, they do the suitability right up front, you'll know if the client qualifies right then. They'll say, yeah, your client, meets suitability and is approved. So I tell people, make sure you know and look at the numbers before you go through it with the client, so you don't get saying no, right with the client. So on their personal protection choice, this is the same scenario. We're putting in $250,000. Okay, so putting in $250,000, and at the end of year one, that's going to grow to 285,000. Now, under this family protection over here, okay, 250,000. Year one, it grows to 275,000. So they're picking up an additional 25,000. By end of year two, now they're at 300,000, 325, 350. By year five, they're at 375,000. Year six, 400,000. So the family protection is a death benefit. Now, with Nassau, this is paid out in one lump sum. There's no 5-year deferment on their death benefit. So that's a little bit nicer. If somebody waited 10 years and they didn't turn on the income in this thing, the death benefit's now going to be at $500,000. That's where it caps out. Okay. So at $500,000, and they pay that out as a lump sum, where accumulation value, oh, that's the guaranteed income value. So the guaranteed income value, this is so with these products, they have two choices on how you want the money to grow. So if somebody's going to take the income between year one and year four, okay, they would want to do the income for today. And they determine that income again. They give you a 30% bonus. Year one, you make 30% on your money. Then year two and three, it comes out to like what was it, 5.75, something like that, Peter, for the next 2 years. Okay. Now, if you have a client that's looking to take income in 4 or more years, you want to do the income for tomorrow. And that's what's being represented here. The income from tomorrow grows. So the guaranteed income side grows at 14% simple interest every year until deferment for 10 years. Okay. So, everybody understands what's the difference between simple and compounding interest. So if you have $250,000 and they're adding the 14% in each year, it's on the $250,000, not the compounding amount. So again, in 10 years, your money would grow to $600,000 guaranteed, $31,000 income. Now, with Nassau, 79,200 for a nursing home protection. So if you same thing with the confined with North American, they're going to double that to $79,200 for 5 years. But then they have another one. It's called the annual care protection for 2 out of your 6 ADLs. So now they add the ADLs in. They're going to give you, it's like 75%. So now they give you $55,440 per year, tax-free, right? Excuse me, not tax-free, taxable, excuse me. So they double your income, excuse me, not double it. It's increased by 75%. And so they're going to pay that out to you for 5 years. So you have the nursing home doubler is built in for 5 years. And then you have 2 out of your 6 ADLs where they pay that money to you. Doesn't have to be due to a confinement. And then they have the additional death benefit. So that death benefit grows at 10%. Okay, if you're under the age of 75, guaranteed for 10 years. So it grows at 10% per year. Okay, and you see year 10 hits the 500,000 and stops, right? So it's guaranteed to grow for 10 years at 10% or until you turn on the income. So if you turn on the income in year 4, the death benefit's only going to be 350,000. So here's another way, again, to increase that death benefit and give your client a little bit more there if they don't qualify. And again, it's with Nassau. Nassau, been in business a long time. And, you know, I've written a lot. Also, Nassau is another great company to turn on the income immediately. If you have someone who wants the income immediately under that strategy, income for today, they're going to get 30% on their money. That's a big, so 30% on whatever they transfer in, then the income value comes off of that. That's big. Now, will this contract really give you tremendous growth off of the indexes or really, anything? No. Okay. It's going to be low. Okay. But if your client totally needs income and hasn't saved a lot, and they take that income strategy for today with the 30% bonus, that's again, I showed it last week. That's a powerful way, right? So, I, you know,
And I don't know that everybody, did the math on that, but at $250,000, a 14% roll-up rate is $35,000 of credited growth for
every
the
year
income purpose for every single year, guaranteed rain or shine.
for
So when
10
we're going
years.
into the volatile market space, and we're not sure what tomorrow's interest rates will bring, and somebody wants to know exactly how much income they're going to have, this is a suitable application.
Yeah, just, and again, people are going to need income in retirement. A lot of people go, well, they get stuck on, I want growth too. Well, no, if you look at everything out there, okay, you need income and guaranteed income that's going to last. It's not going to be hit by fluctuations because the killers of money in retirement are what? Market risk, inflation, taxes, right? And longevity. Those things affect income in retirement. So that's why a lot of people run out of income in retirement. USA Today did a poll. And they asked, what is the number one fear in retirement? You know what the number one fear in retirement was? It wasn't death. It was running out of money before one passes away. So, and I just read in the insurance magazine, Insurance Net, that right now, almost 76% of Americans nearing retirement, their biggest concern is guaranteed income because they're seeing what's going on in the world, the roller coasters, the craziness, right? People understand that. So also death benefit, I mean, if boost everything. So Peter, that's what I got here.
All right. Too many
And,
share.
and if you guys, you think of, 30% on $250,000. I mean, that's a big kick, right? On somebody's money, which I guarantee you in the market, if a person hasn't been saving, where are they going to get something like that, right? But you just need to make sure that you've explained it, that this is for income value. So here's income strategy for today. The 45% boost is if you keep it up until end of year 3, your total return over that 3-year period would be 45% on the income strategy for today. That's crazy, right? But if you're going to take income after year 3, you want to use income strategy for tomorrow. 14% simple interest roll up for 10 years. And if you take the protection choice, then you could get the additional death benefit and also the nursing home and nursing 2 out of your 6 ADLs. And it's a great program, you know. And when you look, go ahead. Go ahead. Who was talking?
It's okay.
All right. So those are 2 programs that we have available with companies. I don't know if you guys knew we had them, so I'll let Peter take over and
I
go
have a
from there.
question.
Go ahead.
Sure, go ahead.
All right, so suddenly my 70 plus comfortable federal employees are retiring and they haven't looked into anything. They seem to be apathetic to the fact that the TSP will automatically create an RMD for them. So two things I want to get clarified are if they retire, say in April, May, or June of this year, does the RMD start next year? And then number 2, are these products suitable for people over 75 to 85?
Oh yeah. I've written lots of people over those ages where their income would include to make sure it meets the RMD requirements. No problem with that. And your
These
other
be,
question, go ahead, Peter.
yeah, these will not be suitable for over age 80 for either for North American or for
Yeah.
Nassau. We do have another variant. I'll show you in just a minute for over age 80 clients. As far as taking out their RMD, it's the year that they retire. If they are over that age of 75, or should be over the age of 73, that will begin. So if they're retiring this year, they're over the age of 73, the RMDs would be due this year.
Wow. And they don't know that. All right. Thank you.
Yeah. So
I
if we
haven't
stop
I haven't
share,
worked with I haven't worked with too many federal employees that were over 80, but I'm sure there are some out there. But all right. So
just click
all right,
stop share the
there you
one
go.
there.
There you go.
All
All
right.
right.
Let me share mine. All right. So I got a call from an agent. She's not on here today. She called me the other day. Hey, I've got a client, trying to put some money someplace to grow it. He's 80 years old. We're talking about death benefit, talking about, how do we maximize everything with some growth? F&G's product, the Prosperity Elite, there's the Prosperity Elite 7, 10, and 14. This product goes issue age up to age 85. We do have a product with a bonus over the age of 85 up issue age 90. It's only a 5% bonus. I'm just telling you, really really think hard about it if you're going to do that. There's got to be a very specific reason with estate planning primarily that you would be looking for those additional
Peter,
benefits.
real quick, the whole thing about working with people over the age of 80, I hope that any client you have that you're working with, say over 70, okay, that you are making sure that you're documenting all emails and communications and you are thoroughly educating them and at least, making sure that this is suitable for their needs, okay? You don't want this to come creeping back on you. Many times, because I do things virtually now, I tell them, please have your granddaughter or daughter, somebody in on our virtual meetings, okay? I document that because otherwise you're looking to have a problem in the future, okay? If they're 80 years old and you just communicated with them and no one else has been in on it and something goes bad, okay, you're going to be sitting there, okay? So you make sure you have things, you've sent them emails, you've sent them marketing materials about the product, you've called, you've talked to them, you met with them. I do income analyses with them and stuff like that. It's important because you don't want this to come back and hit you in the kitchen. So, all right, go ahead, son. Sorry.
No, that's great. I appreciate it. Everybody, these are important concepts that we hope everybody is paying attention to. Um, these are the kinds of things that get you or keep you from getting into trouble. Um, I'll dive into that in just a second here. Come on. So let's go back to Prosperity Elite here. So the Prosperity Elite product with F&G, I highly recommend this. We've used this probably about 5 or 6 times. What's beneficial with this is that it actually has a separate protection package, which has an enhanced death benefit. That enhanced death benefit will continue to grow until the individual dies or they turn on income. The enhanced package, or excuse me, there's the enhanced and the protection package. So if we look at the under 70, it grows at 6%. If they are in a couple different states here, it's at 5% for the death benefit. 71 to 85, it's 3% and 2.75, or the protection package. So if you go with the enhanced version that has a protection package, look at the growth rate, 12% under 70, right? 6.5 between 71 and 85. That's compounding. It's going to grow at that interest rate on the death benefit. So every year it's growing at 6.5%, or depending on your state, if you're one of the other states, 5.5, 5.75 in California or Florida. So John, you're in North Carolina, so that's 6.5% growth rate compounding on the death benefit up until age 85 if they don't turn on income.
Awesome. Awesome.
So, and this is issue amount is as low as 10,000. So minimum premium amount is 10 grand, folks. Okay, 10 grand. This is not just for higher net worth individuals. We could go into the indexes at another time. Really, the focus is how do we have that alternative story about death benefits? The death benefit pays out in a lump sum, so this is not installment based. So far, the only one that's installment based that we've shown you is the North American product. The product with Nassau and the product here with F&G both have immediate lump sum benefits that are paid out on those. Unlike the Nassau, has a compounding interest rate. So in 12 years, this is going to completely double the money. One of the beautiful things is that we've got, between ages of 71 and 85, we actually have more than 10 years. So if we don't know how long I'm going to live, but I want to have a growing death benefit, this will grow until age 85. Age 86, it stops growing, right? It's capped out, whatever that's grown to. So maybe you have some money, whether it's qualified or non-qualified money, that you're putting into a trust and you're looking for a way to grow the death benefit on that money. Aside from, we could use, just a pure accumulation product. We could absolutely do that, but we're not sure about how the market's going to grow. So let's look at a death benefit focus. So you could put this in and it's going to grow at a guaranteed 6.5% on the death benefit side. Now, whichever is the greater. So if the accumulation is greater than the death benefit, you get the accumulation. If the protection package is greater than the accumulation value, you get the higher of the two. That's awesome because we can still play the opportunity of market growth on the accumulation side, or we have this backup of 6.5% compounding until the individual passes away. It's a great way to kind of have your feet in like both places here, playing both the guaranteed and the accumulation when we're talking about legacy money being passed on for the future. Yes, it does have an income. You could activate that income. I'm going to tell you it's a decent income package. It's level, so it's not an increasing package, but that is the Prosperity Elite 10. Definitely worthwhile to keep in the back of your mind when you're looking for something that issue age is over 80. This is that 85, 82, 83, 84. You're in luck. This is a product that you can sell and carry with, some pretty good confidence. Once again, issue numbers up to $1 million in this. 10,000 is the minimum. It's got decent growth rates on this. The 7-year product is, available in all the same states. Um, has a slightly different cost factor for the protection package or what they're going to pay on the 7-year. But let's look at the protection package on the 14-year product, just in conversation. If you have a younger client, right? They just want to put this money aside for their kids, leave it as a legacy. They're really not worried about it. They got other money. It's got a 14% roll up rate, folks. A 14% roll up rate compounding interest. That's ridiculous. Okay. So not a 14% simple, a 14% compounding. So that's a huge benefit when we look at protection packages going forward. That's going to continue to grow up until age 85. That's rain or shine. That's happening. Doesn't matter what the market does. If the market is up, you might have a chance to outperform that. I doubt it at a 14% compounding. That's going to be tough. So this is really structured as a really solid legacy product. It is a flexible premium contract, so you can do flexible premium contributions, set plans into this as well as IRAs. So you can create those or roll those over here and they can continue
Hey,
contributing.
Peter, hey, real quick on that, with being able to add money in or do uh posits. We a lot of time we as agents forget about, like Peter and I used to do 403Bs with teachers and we'd set it up each paycheck, so much was being thrown into the fixed index annuity. And you could build a great book of business with that. But we forget that as agents that you can actually set that up even for individuals for IRA contributions and other things. And it's a great tool where you could say, hey, you want to put $100 a month, $200 a month into your IRA? Okay. Well, we can do that. Okay. And this product abuse. And we've written this, we have people receiving income off of this plan with F&G that go back 18, 19 years ago. No problem. Monthly income comes in. Everybody's happy. No issues.
Absolutely. Yeah. Let me pull up one more thing I wanted to talk about today. And we're just talking about, once again, that succession of taking a conversation from a final expense or from a sit down with an individual. How do we come up with more creative death benefits outside of life insurance? But let's talk about one life insurance opportunity that everybody has access to. Right now, the core bridge product that we're going to talk about here, the Simply Now Legacy Simplified Issue life insurance product, is perhaps one of the cheapest, based on the research I've done. It is the cheapest guaranteed issue and simplified issue solution. So they actually have both guaranteed issue and simplified issue on the whole life side. Maximum issue amount is 35,000, but it's a very easy process. Like I said, the price point, this is the old AIG product. The price point is pretty easy. They have an app now that you can put on your phone to quote and to do the applications on the Simply Now legacy product. So it's a really easy product to underwrite or get put through in just a matter of minutes. So if you need somebody that needs a simplified issue or guaranteed issue, whole life contract, think final expense. Hey, this is an easy way to write that. Okay. Issue ages, between 50 and 80 is what they're looking for. Face amounts between 5,000 and 35,000. Once again, it's a fairly simple process to get this pushed through. Payments stop at age 95. They've got, a pretty basic cost for the annual level death benefits, $36 annual fee. Graded has a policy fee of $12. I mean, it's pretty straightforward. That's why it's cheaper than, let's say, an Americo or an Occidental. This guaranteed issue or simplified and guaranteed issue is going to be the cheapest solution out there for you. So I encourage you to make sure you have contracting on this product. If nothing else will sail, this one will. Can we do this contract and do, let's just say, Americo and family home life policy? Those three with guaranteed issues, yeah, you could stack all three of them and get about $75,000 of coverage if you did all three of them, or a little bit more than that, maybe 85,000. So yes, you have the ability to stack several of these guaranteed issue products if you want to. I don't make it a big habit of writing a lot of those, but I always have something is better than nothing, right? And especially if you have, the annuities that we just showed you, trying to deploy one of those annuities and maybe also purchasing, a small guaranteed issue policy to give, more short-term coverage to allow the other contract to grow and compound into a better death benefit over the long term. So this protects us on the short term. Long term, it's not going to keep up with inflation, limited death benefit. That's why we want to have that annuity really carry the rest of the way. So they have a whole build chart out on this for the face amounts on the policies. So there's a question. Yep, I'll send you the link on that, John. No problem. Like I said, it's a simplified application process on this. They've got an app now. It's not really that hard to do this. So you can start off with the Simply Now, and then they have the Legacy GI product as well. So any questions on this information that we just shared with you at this point?
Hey, Peter, I wanted to bring up one other thing. In our society right now, well, it's throughout any time, life insurance is one of the main factors that can provide legacy to anybody's family. People tell me, well, what would be a good investment for me to put my money into to make sure my wife's going to be taken care of? Ding, ding, ding. Guess what? Life insurance. Now, a lot of people sometimes go, oh, life insurance, it doesn't work, but it does work. Okay. The richest people in the world use it every day. The Rockefellers, that's how they kept their wealth for generation after generation. Every time there's a new Rockefeller born, okay, they put a huge life insurance contract on because each one of those individuals who are born have a certain ability to receive money from the Rockefeller Trust and invest that money. So let's say they did a bad job during their lifetime in investing. When that person dies, that life insurance goes back into the trust and pays back all the money they would have used during their lifetime. That's how they've done it. Read about it. They've used life insurance to perpetuate their fortunes. Okay. Uh, and when people understand that all the major banks out there, every major bank out there has a huge part of their money invested in life insurance. Okay. Now they don't tell clients that. It's actually called bank owned life insurance. You could Google that. Its reason it's called bank loan life insurance because the Federal Reserve actually had to put limits on how much money they could invest in life insurance because they have a huge portion of their assets in life insurance. Why? Because of the guarantee, safety, and understanding how long the insurance company's been in business and the reliability of it and so forth. So it's used tremendously by every commercial bank out there, okay, to keep their system running too. So key in on facts. Some of the biggest businesses in the world started because they had life insurance. They could borrow the money out. McDonald's, Disney, all of them needed money for their projects, but none of the banks wanted to loan them any money. So what did they do? They took it out of their life insurance contract to start their businesses or to go on with their future on what they wanted to develop for their businesses. So life insurance is a powerful tool if presented correctly and educating the client to the point where the lights go off in their head and then they start to see it as a tremendously powerful tool for them and their family. Once you do that, then you have them and you have a client for life. So just think about those things and get in front of people. If you're not talking to people, you're not making money. If you're not having presentation or appointments, you need to rethink what you're doing for a strategy. Okay. You got to be able to every day, you should be sending out a couple emails or marketing calls every day. A day shouldn't go by in this business where you have at least attempted to contact somebody with some kind of marketing or trying to get an appointment and moving forward. Can't stay stagnant. You got to get off the mark. Okay. You can't stand there. All right. Go ahead, Peter, with your fact finder. I'll be done.
Yeah. I wanted to cover this because I just remind everybody we are in the business of information. Your presentations, your solutions, the products that you're trying to pitch, all rely on information. And what sets apart a professional from an amateur is note taking. That's what sets us apart. Now, with the guidelines from the NAIC, they expect everybody to be using a fact finder. So if you don't have one, you need to email me today and I'll give you a copy of one today. But everybody needs to be using a fact finder. This is so critical on every opportunity that you sit down with. The information is gold. You just don't know how to convert it yet into the opportunities that it presents. And please do not, and I repeat, please do not email fact finders to clients and ask them to fill it out. That is a cop out as a professional. You need to take the time and value the information you're getting from these people. Because buyers are liars 9 times to Sunday, okay? They will not tell you the truth. Now, if you ask them or you ask for clarification about discrepancies in the information that they're providing, you'll get to the truth. But if you expect them to list out all the information truthfully up front with you, you're doing yourself a complete disservice. And more importantly, as you're trying to make, we're now practicing as fiduciaries. Everybody on this call who sells an annuity or selling life insurance, you are acting as a fiduciary. You are following the prudent man clause. And if you don't know what that is, you need to read it today. Okay. The prudent man clause. If a prudent man reviewed your justifications for the products, the solutions that you are providing to your clients, would they arrive at the same conclusion? If you can't make that justification for why you're selling a client an annuity, why you're selling a client a life insurance contract, it doesn't pass the test as a fiduciary and you are liable. That's why it's important to have the fact finder. That's why it's important to do income gap reports. If you need some help with it, let me know. I'll help you with it. You need to have these reports done to justify that reviewing all the available data, you can say a prudent man would arrive at, yes, this person needs a guaranteed income annuity because they are looking for income and this is not suitable for them to put it in bonds and it's not suitable for them to put it in stocks. It's not suitable for them to buy real estate. Here's why. And that's a responsibility every single one of you on this call as a licensed professional is obligated to under the NAIC regulations. So we need to make sure that everybody is following that. So that's why the fact finder is critical. You don't just give it to a client. Why? Because their butt's not on the line when it comes to suitability. It's going to be yours. So if you don't have the information that would justify the solutions you're now presenting to the carrier and to the state with suitability review, you need to make sure it's on there. So I go through this with my clients. I get the information. Yes, it can be painful. Yes, it can be kind of rhetorical. But let's focus in on what do we need out of this? Do I need, do they have a will? Well, yeah, if I'm planning on selling a will or a trust, I need to know that information. Do I really need to know their occupation if they're retired? No, right? I don't need to know their past employer. I don't need a lot of this information. It's not applicable, right? Be smart about this, right? Use some common sense. When it comes to assets, we need to know. When it comes to liabilities, you need to know. Why? If you're sitting down with a client and you see a ton of liability on credit card debt and mortgages, maybe you could help them pay off their debts with one of our programs. Maybe if you're sitting down with this individual and you notice they have a lot of money sitting in CDs. Now, when you asked them if they had any qualified accounts, they were thinking IRA, 401k plan. They weren't thinking CD. There's a lot of times where people have CDs that, for whatever reason, there's a disconnect because it's at the bank, right? That's not an investment. That's just money I have at the bank. So make sure you ask those questions. when we start looking at, how much these people have on life insurance. Can we justify the reason for having life insurance? Yes, we can. But if you can't come up with a solution to an emotional issue that they have or that they don't know that they have, you're never going to sell that policy. So understanding, okay, how much coverage do they have? How much liability do they have? What's this life insurance? Why do I want to buy that life insurance? Well, it's $200 less a month. Yes, but it's going to make sure your wife stays in the house if something happens to you. It's going to make sure that your kids, your grandkids can go to college. It's going to, whatever it is. Having the information is key to developing that story and making the numbers reflect the solution that you want to bring. So planning priorities at the bottom here. This is really important. What is their priority? This is identifying in a pain funnel what's number one, what's number two, what's number three, what's number four. We need to know what makes these people tick. It helps us to understand the psychology, understand, what kind of personality type they are. This is critical if you're not doing this, okay? Please make sure that you follow up with this, because this is, once again, if I'm sitting down and I'm helping you run a case management, I'm going to be asking these kinds of questions, right? What's important to them? This is a personal fact finder. We have a business owner fact finder. It has 21 different solutions and priorities, okay? We throw a lot more in. We need to understand, what is it that caught this person's interest? When you're talking with them, they say yes to. It's kind of like, there's a difference between people that raise their hand on social media or want to look at something that's like, oh, that's interesting, versus somebody that's like, oh, I want that, right? There's a difference between two people raising their hands. We can't see that difference initially. It's going to take some unpacking for us to identify that. So it's critical that you fill this out, because I can tell you, anybody that sends this fact finder to a prospect will not get that information. They will not take time to do this, not in detail. Okay. So just in closing today, once again, the most important thing that we can offer our clients is our diverse products that we have, the ability to have solutions that are outside the box. So we're talking about death benefit. Yes, we've got guaranteed issue products, but we also have annuities that we can put in place for legacy planning.
Hey, Peter, the biggest solution is what you guys have is you're presenting yourself, and you got to come across as professionals, that you know what you're talking about. And I'll give you a little funny story. When you talk to people about life insurance, you know, most men will say, "Oh, I don't need it. I'm gonna live forever." You'll talk to them, and the wife's sitting there. When I first went to work at Prudential, I had a sales manager, and I was like 23. And the sales manager was my age, and we had a big office, and we hit it right off. So he said, "Pete, I'm going to train you up." So we went on this point one night. It was a pretty big case for back then. It was like $200, $300 a month. And the husband's sitting there, and the guy working with me was named Rod. And he goes, "Rod, I don't think I really want this life insurance. I don't think I need it. I have enough of assets and everything else." And I remember Rod looking at him. He grabbed a pen out from the guy and looked at him, he goes, "I guess you don't really love your wife. And maybe I need to present this to the guy who would marry your wife afterwards." And I was like wanting to crawl into the table. But that made that guy think. Now, probably could have got kicked out of the house too, but he made the guy really, really think, you know. And how much do you love your family? You know, I mean, the loss of income, the loss of your family, the loss of your business, being able to continue. We are offering a huge, precious gift that so many people do not understand how it will protect and perpetuate their family. Do they want to see their family without a home, without income, without anything? And everybody knows how hard it is today to make a living, or even go to the grocery store. You got to mortgage your house, right? So all of these things are important. So you got to be able to communicate those things. And there are so many people out there that are just waiting to hear the right story. Okay. They're just waiting and they're begging. Okay. But unfortunately, a lot of times they just run into salespeople and they
Yep, they
can't
run
touch,
into,
yeah, they can't touch their hearts. Okay. They can't reach that inner being because they're there with just commission breath, right?
or
So
they're just an insurance salesman and not a financial professional.
that's correct. Okay. And that's why, like I said earlier, the fax finders and all that, is important. Education, if you don't have the facts, well, you better make sure that you have things, written out. I mean, I make records, when I talk to somebody or other people on and on the call. It's very important in today's society because we also live in a society where, lawsuits, people are lawsuit crazy with attorneys, right? And I read horror stories every day, but the information I get on our industry, where agents are getting sued like crazy for things that really weren't, I could see where the consumer could have twisted that, but you got to be really careful out there. But we are here to help, okay? We're not a mega agency by any means, but we are a caring agency. I hope you know that. We have worked years and years as agents, and we still work as agents. Okay. We understand what you're doing. We just want to get the right tools, the right products at the commission levels you're happy with in your hands and help you be able to tell those stories to people who need to hear them. Okay. With that, we will all move forward. We
Yep.
want to build a place where people can come and have own their business and prosper. So thank you.
Thank you, everybody, for your time today. We will have the 3 o'clock for the business owner stuff. We'll be on at 3 o'clock Eastern here in a couple hours. So thank you very much. I will send contracting out to those that requested it for Corebridge. If you have any other questions, just let us know and we'll get you the information. Thank you.